This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Signs of fatigue? The market falls as investors find reasons to dial back their enthusiasm for stocks.
Not very merry. Target says the holiday quarter will not be a jolly one, and shares of the big box chain stumbled.
The fine print: there's a provision in the Senate tax proposal that would limit choice for investors, and it could prove very costly. Those stories and more tonight on Nightly Business Report for Wednesday, November 15th. Good evening, everyone. I'm Sue Herrera.
And I'm Bill Griffith, in tonight for Tyler Matheson, coming to you once again here from the New York Stock Exchange, where stocks did fall yet again. Uncertainty appears to be creeping back into this market lately, as attention remains squarely on the potential for tax reform, on lower oil prices, and on the health of the economy. When all was said and done, the Dow Jones Industrial Average dropped another 138 points, closed at 23,271. That is its lowest level in 3 weeks, by the way. The NASDAQ was off by 31, and the S&P 500 fell 14, but it does still remain just 1% from its most recent high.
And tax reform is indeed a big deal for the markets and investors. This afternoon, Senator Johnson became the first Republican to say that he will vote against the Senate tax plan because he thinks it unfairly benefits corporations more than other types of businesses. The Senate can lose only 2 votes and still pass the proposal. But as Ilan Mui reports, there are a lot of changes being made, including one that could make your tax cut temporary.
The Senate adding 2 bombshells to its tax plan, getting rid of the individual mandate for health care and making the tax cuts for households expire after 2025. Now, both of these measures could complicate the political negotiations that have been underway for weeks. Today, Senator Ron Johnson of Wisconsin became the first Republican to come out against the tax plan. And Republicans can only lose 1 more senator and still get this passed. Now, Republicans didn't have the votes to pass the repeal of Obamacare, but Senate leadership says this time is different.
So in the end, keeping the individual mandate tax in place means retaining the status quo, which is not working too well. Zeroing it out means we have a chance to provide greater tax relief to middle-class families through both reduced penalties and lower overall rates.
The proposal in the Senate eliminates the penalty that people have to pay when they don't have health insurance. The government estimates that this will raise $318 billion over a decade. But Democrats say that's just because fewer people will sign up for health insurance, which means the government will have to pay fewer subsidies in order to help them afford it. Democratic Senator Claire McCaskill says that means the money is really coming out of the pockets of the poor.
Is there a ferry that's dropping it on the Senate?
What?
The money you're spending is coming out of Medicaid and subsidies to people who make less than $50,000.
The other controversial change under consideration is making all of the individual tax cuts temporary. The lower rates, the increased exemption for the estate tax, the doubling of the standard deduction, all of those would go away in 2025. Now, lawmakers don't have a lot of time to digest these details. The Senate is scheduled to vote on its version of the tax plan this week. The House will vote on its tax bill tomorrow. Right now, Republican strategy appears to be go big in hopes that they don't have to go home. For Nightly Business Report, I'm Ilan Mui in Washington.
And there is another provision in the Senate tax plan that's getting investor attention. That provision would have investors sell their oldest shares first, which typically results in a larger capital gain. A bit later in our program, we'll discuss what that could potentially mean for you. Bill?
And there's another reason for the recent market caution here soon. That would be oil prices. Energy shares dropped for a 4th straight session today, tracking the price of domestic crude. An unexpected increase in stockpiles and a downbeat outlook from an energy watchdog both contributed to today's decline, which took oil prices down to $55 a barrel.
Treasury yields also slipped following the release of 2 key economic reports. Retail sales rose 0.2% last month. Most economists weren't looking for any increase at all. The increase was due to the fact that consumers bought more cars, furniture, and clothes. Separately, the Consumer Price Index was up ever so slightly, but it was enough to cause the market to price in further interest rate hikes from the Federal Reserve next year.
And here's why that's important. Expectations that the Fed will tighten interest rates could push yields on the 2-year Treasury higher. And at the same time, inflation, though trending upwards, remains subdued, limiting a rise in the yields of the benchmark 10-year note on the longer end of the curve. The difference between the 10-year and the 2-year now is currently at its lowest in about a decade. In other words, the yield curve is flattening.
And some say that flattening yield curve means investors are worried about the broader outlook for the economy and stocks. So is the world's biggest bond market sending a signal that stock investors can't or shouldn't ignore? Bob Michel is the global head of fixed income at JP Morgan Asset Management, and he joins us now to talk more about that. Welcome. Nice to have you here, Bob.
Good evening. Nice to be on.
So what is the bond market telling you as it pertains to the economy and stocks?
Well, it's telling us a couple of things. I think, first of all, it's raising some red flags. If we look at the high yield market in particular, yields have been rising there for the last few weeks, or there's been a bit of a sell-off. And when we look at where yields got to at 5.4% a few weeks ago, that seemed to be too low and overly optimistic on corporate earnings and growth. We've now backed up to 6%. I think that's more realistic.
But we're also in a situation, Bob, where yields overseas are much lower than they are here in the United States. So international investors find themselves coming to the U.S. and buying our bonds because they get a much better yield, a much higher yield here. That's another reason why we're seeing this flattening of the curve, isn't it?
Yeah, that's true. I think you're right to be somewhat concerned about the yield curve flattening because, after all, the Fed is taking the punch bowl away. They are leaning into growth and inflation before they become too much of a problem. And stocks in particular don't like the Fed leaning into anything. That said, you still have overly accommodative monetary policy overseas. You have negative yields, you have the printing of money, and investors there are exporting that capital to the U.S. market and buying our bond market. So that's helping to stabilize things quite a bit.
Do you view, as some do, what's happening in the bond market right now as a sign that the stock market may be either peaking or heading into a correction mode?
We don't just yet. What we're seeing in the high yield market and with the yield curve, I think, are pretty normal for this part of the cycle. Some profit taking, some response to Fed tightening, but other things look pretty good, right? The jobs market looks pretty healthy. There's talk of tax reform and tax cuts. And central banks, even though the Fed has begun the normalization process, they're still overly accommodative and providing a lot of liquidity into the system.
Quickly, before we let you go, would you buy treasuries right now?
I wouldn't. I think credit is the better buy in here. I like the backup in high yield to 6%. I think it stabilizes in here and rallies going forward.
On that note, Bob, thanks for joining us. Bob Michel with JP Morgan Asset Management. Bill?
Thanks, guys.
All right, well, it hasn't happened in a while, but General Electric was the best performing stock in the Dow today, up 2%. This after that sharp and steep decline following the company's announced plan to restructure, which we've been telling you about here. But how secure is GE's membership in the blue chip index Dow Industrials? Bob Pisani takes a look at that for us.
GE's sacred spot as the longest running member of the Dow Jones Industrial Average could be in jeopardy. I say could be in jeopardy. So the workings of the index committee that determines which stocks stay in and which ones drop out of the Dow are a bit mysterious, frankly. But it's clear there is no price threshold where you can get thrown out because you drop below a certain price. However, there are other things. GE is trading at $18 right now, but AT&T was $33 when it was removed in 2015. Alcoa was $8. Bank of America was $14. Both were removed in September 2013. Citigroup dropped to $3 when it was removed in June 2009. GM was 27 cents when it was dropped at the same time. So there's clearly no cutoff price that would get a company kicked out of the Dow. But the price relationship with other stocks may be very important because the Dow is a price-weighted index. Now, David Blitzer, he's the chairman of the index committee at S&P Dow Jones Indices, has said that he prefers the ratio of the highest price stocks to the lowest price stocks to be less than 10 to 1. Now, GE is $18. The highest price stock in the Dow, Boeing, is $261. That's nearly 15 times the price of General Electric. So by that standard, GE is definitely a candidate to be removed from the Dow Jones Industrial Average. Another way to look at this is not the price, but by the state of the company. So the committee dropped Alcoa in 2013, partly because raw material companies just weren't as important as they used to be. But a better parallel may be Hewlett-Packard. The PC maker was dropped from the Dow in 2013, not just because of the low price, but appeared to be because it was a former tech giant that had fallen on hard times. The company's board of directors were struggling. The company seemed unsure of what it should be doing next. Does that sound familiar at all? For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Coming up, why the new tax plan could be a problem for investors who are part of the buy and hold crowd.
Airbus has inked the biggest airplane order ever. The European airplane maker has signed a deal to sell 430 jetliners valued at almost $50 billion to a private equity firm that has stakes in low-cost airlines around the world. That deal was made at the Dubai Air Show.
It was a rough day for Target shareholders. That stock fell nearly 10%, despite reporting solid third-quarter results and lifting its full-year guidance. But it was what the company said about the critical holiday period that sent chills through investors. Courtney Reagan explains.
Target hit a bullseye with its third-quarter results, but investors are disappointed with the holiday forecast. And CEO Brian Cornell says he's surprised with the reaction to the retailer's cautious fourth-quarter profit expectations. In an exclusive interview, Cornell says he's confident going into the holiday quarter.
We feel really good about our performance, the progress we've made, and I feel really confident that we've got all of the elements working well as we go into the fourth quarter.
So it doesn't sound like you're worried about what you've seen in early November. You feel pretty good about going.
I feel great about the start to the year.
The big box retailer is undergoing a multi-year plan to spend $7 billion improving its digital business, remodel stores, pay store employees more, and lower prices. While it may be the right strategy to compete, it pressures profit.
As we look forward and think about 2018, we struggle really to see how earnings can really grow in the outer years.
While Target's comparable sales came in double what analysts expected, almost all of the growth came from online sales. Store sales at Target's more than 1,800 stores are flat. That's concerning when Target's online sales are less than 5% of total sales, but responsible for nearly all of the sales growth.
I feel good about our store performance, whether it's someone ordering online and picking up in a store. Now in Minneapolis, someone ordering and driving up to a store. We ship from store, obviously, in now 1,400 locations. So our stores really enable our digital growth, whether it's in urban centers or on college campuses. Stores still matter.
Target launched 4 new original brands this fall, including Hearth & Hand, co-designed by HGTV stars Chip and Joanna Gaines. Cornell says shopper reaction to that brand has been amazing, and it's been a traffic driver. But sales in traditional traffic driving categories, like essentials, are lower, and grocery needs improvement. Target has lowered prices on thousands of items, hoping to drive traffic into stores for household staples and for checking off shoppers' holiday wish lists. For Nightly Business Report, I'm Courtney Reagan in Minneapolis, Minnesota.
Meanwhile, Cisco's security business helped that company report better than expected earnings and revenue in its most recent quarter. The world's largest network gear maker has been diversifying its businesses away from just switching and routing, and now it may be paying off. Shares of the company rose in initial trading and the after hours tonight. Josh Lipton has the one key takeaway in tonight's Cisco report.
Cisco has been moving its core business to a recurring revenue model, meaning instead of a one-time sale, Cisco is counting on revenue from subscription-based services. Now that's critical for Cisco because the market for its hardware, meaning switches and routers, doesn't have much growth left, so Cisco is now focused on distributing more of the software and services that companies are buying. Cisco now says recurring revenue makes up 32% of total revenue. Brian White of Drexel Hamilton says that's important for two reasons. It means investors have greater visibility into the future of this business, and investors generally assign higher multiples to those companies with stronger recurring revenue. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Nelson Peltz reportedly wins a board seat at Procter & Gamble. That's where we begin tonight's market focus. According to CNBC, the activist hedge fund manager has been elected to P&G's board of directors after a recount showed he won by more than 40,000 votes. P&G says the vote is subject to review. Peltz, whose Trian Fund Management has a more than $3 billion stake in P&G, has criticized that company for lagging in innovation. Last month, P&G said Peltz lost his bid to win a seat by more than 6 million votes. P&G shares initially rose in the extended session, but they finished the regular day down a fraction to 88.23. Acorda Therapeutics said 5 patients died from sepsis while being treated with the company's experimental Parkinson's disease medication. The drug maker said it has stopped enrolling new patients in the study and plans to speak with the FDA about the treatment. Acorda shares plunged nearly 40% to $17 even. And scientists at Sangamo Therapeutics have tried to permanently change a gene inside a patient's body in an effort to wipe out an incurable disease called Hunter syndrome. The experiment was the first of its kind, and while the results won't be known for months, this new and precise form of gene editing could offer new hope for people battling deadly diseases. Shares of Sangamo Therapeutics jumped more than 13% to $14.65.
Defense contractor Raytheon says it is adding $2 billion to its existing share buyback program. Shares initially rose in after hours following that announcement, but ended the regular session down a fraction to $182.85. And after the bell tonight, home furnishing retailer RH raised its earnings and sales guidance for the current quarter. The company said that the improved outlook is due to stronger business performance and a $2 million tax benefit. Shares initially took off in after hours trading, but ended the regular session down 6% to $83.30. And we recently told you that Hasbro had approached Mattel with a takeover offer. But Reuters says tonight that Mattel is not interested. Mattel reportedly voiced antitrust concerns and said the proposal undervalues the company. Mattel shares finished down 1% to $18.32, but it was higher in the after-hours market. Hasbro shares were off about 1% at $94.75.
The head of the Consumer Financial Protection Bureau is stepping down. Richard Cordray was appointed by President Obama to lead the consumer watchdog agency that has been at the center of a number of political controversies. The agency was set up in response to the financial crisis to police things like mortgages and credit cards. Republicans have long argued, though, that that agency has too much power.
Okay, now to that new provision in the Senate's tax plan that we told you about earlier that could take away your ability to pick and choose which stocks you want to sell out of your portfolio and the number of shares. Under the new rule, if it were to pass, investors would be forced to sell their oldest shares first, FIFO, which typically has a larger capital gain. If the change does happen, investors would pay an estimated $2.7 billion more in taxes over the next decade as a result. Robert Gordon is the president of 21st Securities. He joins us now to talk about this. How big a deal is this? I mean, you have a choice right now, but if you had to sell those older shares first, how big a tax bite are we talking about here?
Well, it really depends on each client's situation. If the prices that they paid for the shares are pretty much the same, even though it went over many years, it wouldn't matter. But the markets move. People don't buy all in one big lump. And most of the time, people do have specific lots that have cost bases that are quite different than each other. There are 4 different tax-efficient strategies that use specific lot identification in order to get the most juice out of them, and those 4 strategies will be severely impacted.
Bob, would it also affect people who are in mutual funds, in ETFs and the like, or is it just individual stockholders with individual stock?
Well, the first three issues that I would discuss are as they relate to individuals, but the fourth and the bigger structural issue is that exchange-traded funds, or ETFs, are traditionally more tax efficient than open-end funds because they do something called a redemption in kind under Section 852. And when they do that, they deliver out the shares that have the lowest cost basis, and when they deliver them out of the portfolio, the capital gain literally evaporates. And as an example, Vanguard's ETF and Vanguard's open-end fund are the same fund. And I believe that when people cash out of the Vanguard ETF, the market makers may very well be given shares that the Vanguard open-end fund bought at low prices many years ago. So it's going to really hurt how tax efficient the ETFs can be. And it's going to take away a lot of the benefit of the ETF's edge. And I think that's why you see the Investment Company Institute being front and center on trying to beat this proposal back.
Okay, now we should just remind everybody, this is only a proposal. It hasn't been passed. But if it were to pass, especially before the end of the year, because this would take effect January 1st of 2018, what would you think people would want to do before the end of the year?
Well, I think that there are two strategies where this is very important. One is if you owned 1,000 shares and you have 10 different lots bought at different times, and you knew you were going to sell over the next year or two, if you sell after January 1st, you're going to be forced to use your FIFO price. And if you see that would create a giant capital gain, then maybe what you should be doing is accelerating that selling now and identifying the shares with the highest cost basis, triggering the least amount of gain. The second issue is people that give money to give stocks to charity. If you bought a stock for $1 and it goes up to $60 and you give it to a charity, you not only get a $60 deduction, but you're also forgiven your capital gains tax. Someone who is going to give shares to charity may want to do it sooner and identify their lowest basis shares.
All right, I'm sure some accountants and financial planners are getting some phone calls in the next few days here, that's for sure. Robert Gordon with 21st Securities, thanks for joining us tonight.
Thank you.
And coming up, time, of course, is money, so are data. That's why hackers want it and why companies are spending a lot to protect it.
Nearly half of cybersecurity professionals believe their company could face a major disruptive attack in the next year. That's according to a survey released this week. After major breaches, companies big and small are working hard to defend against hackers. Andrea Day takes a look at what's at stake and what can be done to keep businesses safe.
It's easier right now to list all of the Fortune 500 companies that haven't been breached than it is to list the ones that have.
Massive security breaches that have some companies scrambling to recover.
Data is becoming more expensive than it's ever been.
Brian Vecchi is in the business of securing data at the cybersecurity firm Varonis, working with brands, he says, that invest millions to keep data safe.
Data security can take down the entire organization.
And he says far too many have data just sitting wide open. Varonis did risk assessments at more than 1,000 companies and found 47% had more than 1,000 sensitive files open to all employees. Data, he says, that should be treated like cash in a vault.
There's no more big fence that you can put up to keep people out.
So he says the key is knowing how data is being used.
We don't live in a world anymore where all of the data or all of the information is in a single building or a single data center. Our employees and our users access data from anywhere.
Tapping into work from home, using networks that can be connected to their smart devices, like door locks and TVs. If those devices are unprotected, he says they're all potential vectors for attack.
They all have default security settings. And one of the biggest issues for consumer security these days is that many times people don't change the default settings.
And according to Vecchi, using the web can leave critical data exposed.
Any website that you go to, any application that you use inside of a web browser is a potential for something to go wrong.
The most important thing to watch? Files and emails used by the company on a regular basis. Make sure only the right workers have access and that it's all being carefully monitored.
You can't catch what you can't see. It's not a mission impossible, somebody breaking in and using the most advanced technology to get in. It's people just looking for a little bit of an open door. These systems are so complex that all it takes is one little chink in the armor, and suddenly you've lost.
The good news with all this is that companies are starting to wake up. According to Varonis, 80% of IT professionals worldwide say they've changed or plan to change security policies based on recent attacks. For Nightly Business Report, I'm Andrea Day.
By the way, before we go, we want to tell you about a special program that we're putting together on retirement that will air on Thanksgiving. And we want to hear how you are saving for your later years and some of the challenges that you're facing in doing that. Log on to our website at nbr.com, click on Contact Us, and tell us your story. You can also, by the way, post a comment on our Facebook page, or you can tweet us. If you have a question, our retirement expert may be able to answer that. Email us a short video of that question to nbrmail@cnbc.com.
Can't wait to hear your questions. That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And a happy birthday to you, my dear friend.
Oh, thank you so much, Bill. I appreciate it.
I'm Bill Griffith. Have a great evening, everybody. Celebrate with Sue. See you tomorrow.
Woo-hoo.